So when you start to see some of the contagion that's actually happening across the market, is a lot of this just based on leverage, or like how would you, if you were a doctor trying to diagnose the problem? We see what the side effects are in terms of a lot of the contagion, but like where can you pinpoint exactly what has driven this or caused a lot of the issues?
Yeah, so a lot of the leverage in previous market cycles was in these derivative markets that were built out. You can think of the BitMEXs of the world, the Binances of the world. That's pretty transparent. We saw that this cycle, it was with the rise of DeFi, added another layer of leverage. So you had all these funds, all these kind of market participants that were stacking leverage on top of leverage on top of leverage. And while the cycle was going, the bull market was in full force. Everything worked fine. But on the other side of this, we're seeing a lot of that get wiped out and purged. And so I still think there is some leverage out there. There is some bad debt that probably ends up liquidated. And I think that's kind of the slow grind we're in. It's just purging the market of all that debt.
Yeah, it's fascinating to kind of think through this. You got some charts here. Maybe let's go through those, and then we'll come back to Bitcoin and crypto. You've got the U.S. equity plus all U.S. bonds market value not going so hot. Big drawdown here. What is this showing us?
Yeah, total bond market, equity market value basically lost from all-time highs as a percent of GDP. So historic drawdown in record time, even surpassing the COVID lows, right? So you could just see we had this everything bubble that's deflating faster than I think most market participants could have expected. This is a result of soaring yields. Obviously, we know the energy and commodity situation, and so not just crypto specific. Obviously, I think if you add crypto in here, it would be another $2 trillion of kind of wealth destruction. But really, bond and equity markets have lost almost $16 trillion, and that's just U.S. markets. So include global markets, and it's a lot uglier. So I think it's important to just have some kind of context. Obviously, Bitcoin's taken a beating, but it's not isolated, and really, it's about the liquidity tide falling out.
Yeah, I mean, this is just wild when you see it. It's more than the 2008 financial crisis. It's more than the COVID crisis, just absolute off a cliff drawdown there. When we look at Treasury bond futures, what are you seeing here?
Yeah, just kind of another way to visualize this, right? The Treasury bond, the U.S. Treasury bond is the driving force in all global markets. It's still is king. The dollar still is king at the moment. Still as the world reserve currency. And so these are long dated treasury bond futures and they're getting killed, right? So the bond bubble, right? People like to talk about the equity market bubble if you want to think of like the everything bubble, but really what it was it was a global bond bubble. And with this record inflation, and there was high inflation for a while, but as it continued to accelerate, the bond market realized, these bondholders, they were the patsies at the table. And so this sell-off in bonds is really what's causing this pullback everywhere else. As yields soar higher and people realize that the net present value of their assets as duration gets killed, and you can think of the duration aspect as yields rising. So the value of a growth stock, why does it come down when yields rise? Well, when you're doing cash flow models and you have to account for rising cost of capital, even if in real terms it's still negative with current inflation. This is why really this is like kind of another way to view that liquidity tide is when bonds are getting killed. This is treasury bond futures. When the long dated treasury is getting killed, it's going to be a tough environment for risk.
We've got the dollar currency index here, and it's just up only. Looks like what Bitcoin and crypto used to look like, but now it's the dollar strengthening against other fiat currencies. How do you look at this in the macro environment?
Yeah, so we can talk about consumer price inflation. That's obviously top of everyone's mind. It's important to understand that we're kind of in this max pain scenario where inflation is soaring, risk assets are selling off at the same time that the dollar, which is the world reserve currency, is strengthening against almost all global fiat. So the euro, the yen in particular, especially the yen, where the Bank of Japan are conducting yield curve control. This is kind of that max pain scenario for not U.S. citizens, but global citizens, especially emerging markets with dollar-denominated debt. The dollar soars higher. This essentially plunges the world into recession. So the Fed is the Fed actually has kind of a lot of power right now, and are making up for their policy error with this rapid tightening policy. So the higher the Dixie goes, the dollar currency index, even if there's a relative decay in the dollar's purchasing power in real goods and services, this can cause a lot of pain for global risk, and that's what's playing out.
Yeah, I mean, it's just crazy to watch all this and the interconnectedness, I think, of these various assets as the macro environment unfolds. We've got bond market volatility up and equity market volatility up as well. How do you think about these two?
Yeah, I think we're headed for kind of a point of singularity, or a reckoning point. We've obviously had a lot of pain in equities, a lot of pain in bonds, a lot of pain in Bitcoin and crypto. But I think this all kind of ends, or not ends, but it's coming to a head with a blowout in spreads, blowout in volatility in the equity and bond market, and maybe even further volatility in Bitcoin, even though that's quite volatile. So especially bond market volatility, when you have the most liquid asset in the world, the asset class, the bond market, trading with this level of volatility, not seen since really 2008. We're surpassing those COVID highs as we speak. The world's in trouble, or really, global risk assets are in trouble, financial markets. And so probably equity market volatility, bond market volatility explode higher. I certainly don't think that the high for the VIX has been put in. And so, spell some trouble for risk assets. I think we're in a little bit of a bear market rally here. But most of this stuff the charts are saying that the worst isn't over.
And how would you measure how bad it could get? Like, the worst isn't over, but is there anything on these charts specifically around market volatility that would signal, okay, this is where my expectation would be? Is it just, hey, where was the COVID high or where was the global financial crisis high?
Yeah, it's tough to conduct, technical analysis on volatility charts with the VIX. I mean, certain people try to do it, and maybe it works, but I really think what it comes down to, and it's somewhat not unfortunate, but it's somewhat comical that we're at this point where we're all just waiting for a Fed pivot. But essentially, there's so much debt out there. There's so much dollar denominated debt, and yields continue to rise, where the entire world's just essentially waiting for the Fed to cause enough pain for them to pivot. So every time you see these blowouts in volatility, what brings it back in is easing a central bank stimulus. It's not a free market force. And that's important to understand. So I think ultimately what we're headed towards is an absolute explosion of volatility and a reaction by kind of central bank, and a fiscal and monetary response is what we're headed towards, in my opinion.